If you're not making money with mechanical trading, it's because you're making one of the 3 mistakes that I'm about to share with you in this video. And after watching this video, you know exactly what to do to properly build your own edge. In fact, these are some traders that I coached throughout the years, and they've gotten great results. They either had a plan that they received from me, they improved their win rate, they improved the results, they improved the consistency, and I used the same tips with them that I'm about to share with you in this video. If you don't want to miss any of my future content, subscribe so you don't miss any of the videos and you continue learning the right way. Alright, so mechanical trading always starts with building mechanical rules and doing it effectively. But how can you do this? It starts with number 1, which is defining your idea. What's the idea that you want to test, and how can you define it as clearly as possible? So for example, if you want to trade a breakout, what for you is the perfect breakout? What type of range do you want to break out of? How are you going to define the breakout? So for example, you get the popular strategy, the Asian range breakout. First of all, define the Asian range. It's the range between X and Y time. Then you define the high and the low, and then you have a clear mechanical range that you're going to use. The next thing becomes, how are you going to define the breakout? Is it a close through, or is it any break of the boundaries of that range? You're going to define that. The next thing is, where does your stop go? If you buy the breakout of the Asian range, for example, if there's an hourly candle that closes through the high, where does your stop go? Will it be 1 pip below the low of the range, or will it be in the middle of the range? Define that. Then you define the target. Will it be, 1 times the size of the range, 2 times the size of the range? Will you use an exit indicator to exit the trade? That's what you define, and that's your basic idea. And you can use if-then statements for this. If we get an hourly close through the high of the Asian range, I put my stop below the low and I target 2 times the length, or 2 times the size of the Asian range. That's an if-then mechanical trading idea. And that's the way you want to approach building your mechanical trading strategy, and keep it really, really simple with this. The next thing you want to do is test that basic idea to see, first of all, is this somewhat profitable? And also to see if your rules are mechanical enough, because if they're not, you will find that very quickly when you're testing the strategy. And that's totally fine, because then you go back through the drawing board, you define your range, your rules again, to adjust them, to make them more mechanical. Then you test again until you have, clearly mechanical rules, and then you test over the entire period that you want to test. So you test, upgrade the rules to be more mechanical, which will usually, you will figure that out after around 10 trades or so. Then you start again with the new rules, and then you do the entire testing. Now, when it comes to testing, and this is a mistake most people made, is they don't test properly. And if you don't test properly, you basically get this perfect back test that looks amazing, but that doesn't hold any merit in the real market. Some golden rules when it comes to testing. The basic idea should work. So in the previous slide, I gave you a basic idea for trading, for a strategy, an example. That's a basic strategy, unoptimized, no filters. It's just, if this happens, I put my stop here, entry here, target here. That's it. I truly believe that a good strategy should perform without optimization. Doesn't mean it performs perfectly, doesn't mean it doesn't have drawdowns. It means that if you test your basic idea, it should perform and it should provide some form of results. If you need to optimize before a strategy works, the basic idea is probably not good, and the strategy itself is probably not good and not worth pursuing. So keep that in mind. The next rule I have is I only use a maximum of 5 filters, and these target, stop loss and entry are already 3 filters, which means I only have 2 filters left to optimize. When you're optimizing, use filters that make sense. And this is also very important. Most people optimize just based on the data. And don't get me wrong, data is great. You need to have data to support your optimization, to support your ideas. But if it's just random data that doesn't make any sense for your strategy, I believe it shouldn't be used to optimize. Use a filter that makes sense. For example, if you're trading a breakout system, volume of the breakout might be a good filter to use, because that makes sense for the strategy. If it's on good volume, that tends to be, you know, more fuel behind the fire basically, and that tends to give better results. That's a filter that you can test. That makes sense. So also keep that in mind. When you're going to optimize a strategy, please use out of sample data. So if you have tested, for example, 5 years of data for your basic idea, and you're going to optimize, don't optimize on those 5 years. Yes, what you should be doing is find the best optimization in that period, but then you test the optimized strategy on a different period of time that you haven't tested yet and that you haven't used yet. Because if you just optimize over the entire period, the odds of curve fitting really increase, and that's where you get those perfect backtested curves, but something that doesn't really work in real time. So keep that in mind, and if you Google out of sample testing, walk forward optimization, those things, you'll find exactly how to backtest properly. The next point, not something many people talk about, but this is also a mistake people make with mechanical trading. Mechanical trading essentially is, in my opinion, trading with an algo, because mechanical trading is so mechanical that you can essentially program it for the most part, sometimes entirely, and edges go away. That's just what happens. Markets do evolve over time, and sometimes strategies just stop working, and you need to know when to cut the strategy off. And I know you don't want to think about it, but it's really essential. And if you don't determine this before you start trading, you will end up blowing the account trading a strategy that stopped working. So it's really, really important. Now, how do I do this? I use two things: Monte Carlo simulation, and I use probability cones. Those are the two things I use. Now, I'm not going in depth because it's quite an advanced topic, and it's something I discuss with the people I mentor, but it's not something, you know, I'm going to put out there, because it's quite, you know, like I said, it's quite in depth. It's quite unique. No one uses it, but I believe no one really uses it. Some people do. I know some professionals that do, and I learn it from them. But in terms of the broader trading industry, not many people know of this. So I just keep it with my small mentorship group. Now, what I can tell you is that the way I do it is, first of all, Monte Carlo. Like I said, a Monte Carlo simulation basically takes the results that you got and just changes the order of it. Now, there is a bit more to it, but that's the essence of such simulation. So if you're backtesting, everything is in chronological order. If you use Monte Carlo, it will basically throw that order randomly to see what the results were then. And that means that your drawdowns and your outcomes are going to change. And like I said, there is more to it, but what you want to figure out is basically the worst case scenario that could have happened in your backtesting, and use that as a reference point in the future to cut off. Now, you should expect a bigger drawdown than your maximum drawdown from your backtesting. Why? Because you built a strategy on past data, not on future data. So you can expect that the maximum drawdown in the future will be a bit bigger. However, using the Monte Carlo combined with something I call, and what I've learned, probability cones, which basically is a standard deviation from the average returns, the average result of your backtest. And using that, so if you basically your results go below the two standard deviations of your average results, I know this sounds nerdy, but if you Google it, you can find more information. Basically, that tells you that, like, with the standard deviations, 98%, approximately 98% of your results should be within 2%, within two standard deviations of the average of your results. If it goes outside of that, that means there's a highly likelihood that something is wrong. If then also the worst case scenario of your Monte Carlo has been hit, and we don't quickly bounce back to the average, probably the strategy is over. That's like in a nutshell what I personally use. Again, do research on this topic. It's a very complex topic. There's no clear-cut answer to it. But what I want to encourage you to do is really create a cutoff point. As hard as it seems to do, it is really important. Now, what I quickly want to tell you is if you want to work with me, so if you really want the in-depth information about what I use, how I build my edges, if you actually want my edge, that's when you can work with me. And I personally work one-on-one with you if you decide to do this. It's a personalized mentorship. Yes, there's videos, but I have regular Zoom meetings with you, contact via, personal WhatsApp or Telegram, whatever you prefer. And you learn my edge, but you also learn how to build your own edge the right way. So testing it the right way, optimizing it the right way. So not curve fitting, but actually building something sustainable. The deal I always give the people I mentor is I will continue to help you until you have a profitable trading strategy so you can potentially earn your investment back. So basically, people that work with me, I don't stop working with them until they have a profitable trading strategy and also the mindset to execute that strategy. And of course, after that, it's still lifetime support, but that's the deal. I don't want to, when I mentor someone, I want them to get results. And I keep working until results are there. That's just how I approach this. I'm not here to sell 100 courses in a month. I just take on a few people a month, serious people, work with them, and dive into depth in certain topics. That's it for today's video. I hope you enjoyed it. If you have questions, comment down below, subscribe so you don't miss anything, and then I'll see you next time.